At the beginning, I talked about technical analysis being the art of identifying trend reversals and using the weight of the evidence to identify turning points. Now it's time to start looking at this evidence in the form of specific indicators and techniques. The ones covered in this module are what I call basic building blocks because they'll be used time and time again in later sessions as we learn about the other indicators and approaches.
They are peak and trough analysis, support and resistance, trend lines, volume characteristics, and moving averages. We'll start off with peak and trough analysis. Widespread use of computers has led to the development of very sophisticated trend identification techniques in market analysis. Some work reasonably well, but most do not. In the rush to develop these more complicated approaches, the simplest and most basic techniques of technical analysis are often overlooked. One of these is the peak-trough approach. It's one piece of evidence in the weight of the evidence approach described earlier, but it's also the building block for several price patterns and other technical techniques. The concept is very simple. A rising trend typically consists of a series of rallies and reactions, with each peak and trough reaching higher than its predecessor. Then another rally takes place, but for the first time it fails to move to a new high. And the subsequent reaction pushes it below the previous trough. As far as the peak-trough indicator is concerned, this action signals that the trend has reversed from up to down. The opposite is true for a reversal from a downtrend to an uptrend, where point D gives us the signal because this low holds above this one, and at D the price breaks to a new high. We do not know how far the price will rally, merely that the series of declining peaks and troughs is reversed. The significance of a peak-trough reversal is determined by the duration and magnitude of the rallies and reactions in question. For example, this chart shows the S&P Composite at the 2007 bull market high. Now if I introduce some waves that reflect price moves of 5% or higher, you can get a better feeling for the intermediate price moves. See how the November peak was below that of September, and by January 2008 the price was below both the November and August lows, which were at the same level. This reversal of intermediate peaks and troughs signaled a change in the primary trend. Here's an example using daily data. This time I'm going to draw a curvy line manually reflecting the short-term peaks and troughs. As you can see, they're in a bullish formation between February and June. Then we see a failed rally, followed by a move below the mid-June low. That represented a signal that this intermediate trend had reversed so far as this single piece of evidence, peak and trough analysis, is concerned.
The ability of buyers to push prices to successive new highs shows not only that they're more motivated than sellers, but also reflects their growing confidence. When buyers are unable to push prices higher, it offers the first sign of weakness, as it's the first barrier they have failed to overcome. If the price slips a bit and then takes out the previous high, everything's okay. However, if the price then breaks below the previous low, it confirms the initial weakness. In a way, it's like giving your opponents possession of the ball in a football game. The sellers are then expected to run with the ball until the buyers can get it back again.
Occasionally, peak and trough progression becomes more complicated. In this example, the market had been advancing in a series of rising peaks and troughs, but following the highest peak, the price declines at point X to a level which is below the previous low. At this juncture, the series of rising troughs has been broken, but not the series of rising peaks. In other words, at point X, only half a signal has been generated. The complete signal of a reversal of both rising peaks and troughs arises at point Y, when the price slips below the level previously reached at point X, having failed in its attempt to register a new high. At point X, there is quite a dilemma, because the trend should still be classified as positive, and yet the very fact that the series of rising troughs has been interrupted indicates underlying technical weakness. On the one hand, we're presented with half a bearish signal, while on the other, waiting for point Y could mean giving up a substantial amount of the profits earned during the bull run. The problem, if we don't wait, is that the price could well extend its uptrend like this. That's why the dilemma is probably best dealt with by referring to the weight of the evidence from the other technical indicators, such as moving averages, volume, momentum, and so forth. If these other techniques overwhelmingly indicate a trend reversal, it's probably safe to anticipate a change in trend, even though peak and trough progression has not completely confirmed the situation. It's still a wise policy, though, to view this signal with some degree of skepticism until the reversal is confirmed by an interruption in both series of rising peaks as well as troughs. This diagram shows this type of situation for a reversal from a bear to bull trend, as the peaks and troughs are zigzagging down. The price makes a higher high at X, but the bottoms are still moving lower. Then we have a higher low and a buy signal at Y when a full-fledged buy signal is given. Most of the time, the various rallies and reactions are self-evident, so it's easy to determine that these turning points are legitimate peaks and troughs. It's generally assumed that a reaction to the prevailing trend should retrace between 1/3 and 2/3 of the previous trend. This means that if we take the first rally from the trough low to the subsequent peak as 100%, the ensuing correction should be anywhere from 1/3 to 2/3 of that amount. In this case, it appears to be just over a half or a 50% retracement of the previous move. Occasionally, the retracement can reach 100%. Technical analysis is far from precise, but if a retracement move is a good deal less than the minimum 1/3, then the peak or trough in question is held to be suspect. Summary for peak and trough. 1. Peak and trough progression is the most basic trend identification technique and is a central building block for price pattern analysis and other techniques. 2. The size of a trend reversal using this approach will depend on the magnitude and duration of the rallies and reactions comprising the peak-trough progression. Reversals and short-term peaks and troughs signal intermediate reversals. Intermediate reversals signal primary trend changes, and so forth. 3. In order to qualify as a new legitimate peak or trough, a good rule of thumb is that the price should retrace between 1/3 and 2/3 of the previous advance.